Good afternoon and welcome to the latest Hardman Co Private Company Valuations discussion. My name is Richard Angus. I'm Head of Business Development at Hardman Co, and today I'm delighted to be joined by Matthew Burns from MarktoMarket and Iain Baillie from Asset Match, and we will be hearing from them shortly. For those of you who have not seen any of our previous PCV presentations, I'll just give you a little bit of background. We hold these events roughly on a quarterly basis, and they're scheduled to last about 30 minutes. Now, please note that nothing you will hear in the next half hour or so should be interpreted as investment advice. You will hear opinions and facts, etc., but you must make your own investment decisions. So the reason we do this series is because we think it's incredibly important that entrepreneurs in this country are able to commercialize their talents. And we've been facing very tough macroeconomic and political issues recently, which has rather put a lot of investors in the risk-on mode. So they haven't been necessarily that active, but we need to keep clear what's happening in the market. And the one thing that we can get from MarktoMarket is they look at the actual transactions taking place. So regardless of what you feel at the moment, there are some statistical backgrounds that we can basically use to help make a decision and maybe raise investor confidence, hopefully in 2026. So without further ado, Matthew, would you like to just introduce yourself, talk a little bit about MarktoMarket, and then give us a summary of what your current feelings are? Thank you very much.
Yeah, thank you for that introduction, Richard. Yeah, my name is Matthew Burns. I joined MarktoMarket as Origination Director just over 2 months ago now. And my background is that I was actually previously Head of Corporate Finance at a London-based accountancy firm called RPG Crouch Chapman. And 4 years ago, MarktoMarket pitched to me, and we changed over our data platform to MarktoMarket. So I was a customer of MarktoMarket for 4 years. And what MarktoMarket do is they specialize in compiling data at the small and medium-sized cap end of the scale. So that sort of sub £100 million EV deals, we have a lot of data that's not available anywhere else through quite a clever proprietary system that we use. And so MarktoMarket have got their finger on the pulse of what's happening from a valuation perspective. Our clients, we have more than 50% of the top 100 accountancy firms and lots of corporate finance firms and private equity firms. But I'll share my screen now and I'll take you through a presentation. So this presentation it's basically covers what happened in Q3 of 2025. And we create our own indices quarterly. So within this, I'll talk about what the indices are about, and then we'll go into some of the other aspects of the analysis that we do around deal volumes, trends and valuation multiples, and why those trends are happening, what's driving them. So the indices themselves, they cover M&A transactions up to a value of 250 million. So that's kind of our focal point. We have on our platform all deals, so we have all the deals are bigger than that as well, and all the sort of mega deals. But that's where our main focus is, in the small and mid cap size deals, and we believe we have the most complete analysis of valuations at that level. So just to start off with the first chart here. So this is literally just volumes over the last 5 quarters. And you can see that there has been a drop in Q3 compared to Q2. I think it's a 14% drop. But if you look where we were in Q3 back in 2024, we're basically, we're relatively on a par. We're pretty consistent with where we were then. And if you're wondering what happened in Q4 last year, that big spike, that was to do a lot, in large part, to do with last year's budget, where that October month had a huge jump in deals as investors, vendors were worried about what might be in the budget, and so a lot of deals were closed in that final window. But yeah, so that's deal volumes. In terms of valuation multiples, So this again is looking at the last 5 quarters. And what we always do, we show the mean number and the median number. The reason being that sometimes the mean can be skewed where you've got a large number of larger deals that are happening. Larger deals tend to command a higher multiple, and so at the mean they can pull the mean up, whereas the median sort of gets around that a little bit more and is a bit more representative of what's actually happening. So you can see actually the mean number has gone up slightly from the last quarter, but the median has dropped, by a noticeable change there. And if we move on to this is comparing where we were in Q3 last year. So trying to do a bit of a like for like, in terms of trends in the year. And you can see that there's been a relatively significant drop in the valuation multiples compared to the last quarter. So if we have a think about why that might be, and some of the background to the other analysis that I've showed you there. So this shows the average deal size. And again, we show median and mean. Now, in this case, both have increased. And this is the explanation here is obviously, we're getting more sort of big deals at the top end of the market. And so this skews the average. And there was an article in the Financial Times this morning talking about how in America, M&A has been unleashed at the mega deal end. There was a huge Electronic Arts take private deal there recently, and there's been lots of other sort of massive deals, and it's to do with, Trump's deregulation and a kind of a bit of an easier market to get deals away. But that's obviously pulling up the average. And when we look at the constituents of the index by size band, at MarktoMarket, we refer to the different sizes in 4 main categories. So nano is 0 to 2.5 million EV, micro 2.5 to 10, small 10 to 50, and mid cap is 50 to 250. And you can see there's a real trend here away from the smaller deals. So nano, 2 quarters ago was made up 33% of the total deals in the index, whereas that's dropped all the way down to 19%. And on the flip side, all 3 of those, nano, micro, and small, have declined this quarter, whereas mid cap has shown significant growth. And so that is an explainer around why, on average, the multiples are being pulled up. So this chart, what it also shows is a breakdown of the index by sector type. And you can see that industrials and business support services is still the biggest, but there's been a real trend, a real drop-off of the number of deals being done in that sector. This actually includes some of the professional services deals that have been happening so often over the last 5 years or so. So maybe there's a trend for a slowdown there. And similarly with TMTs, there's been a drop there. The other 3, consumer has made a small increase in the quarter, healthcare a relatively big jump, and financial services similarly. So that seems to be a shift in trend away from industrials and business support services deals to some of these other types. And one thing to note on this is that each of these sectors has their own sort of multiple profile, valuation multiple profile. So you could say that generally TMTs tend to be valued, there's higher multiples in that sector. So with that declining the influence, then there's some impact that's going to affect the overall picture there. But this is behind this is quite complex. There's lots of different things that are push and pull factors in terms of trends, but I think this is quite a useful overview. So another thing that we do at MarktoMarket is we have a lot of deal data, as I've discussed, and you can, if you subscribe to our platform, you can get we have nearly 100,000 deals from the last 10 years, and you can find out, information on these various size bands. But that's a very quick presentation from me. Hopefully that's helpful, gives you a bit of a feel for where we are in Q3. And yeah, I'll hand back to you, Richard. Thank you.
Thank you very much, Matt. I have one quick question, which is something that's interested quite a lot of our audience. How much of the activity in the UK market is basically from overseas, as opposed to for UK companies looking to buy other UK companies? Because we get the impression that a lot of the intellectual property in this country has basically, in the past, has certainly been acquired by Americans and in some cases by other countries relatively cheaply, because we don't have the internal mechanism to value some of these companies as well. Do you see any trends or not?
That's an interesting question. I think it all depends on size. Obviously, the classic story is that in this country, we're not as good as the Americans as taking that risk from a sort of, maybe say one of these 250 million EV companies and then creating a multi-billion pound valuation. So what tends to happen is at that level, often we'll lose the ownership, and the Americans will come in and purchase the company. So that's certainly something that continues to happen. I think sector-wise, US interest. So as an example of something that's happened is that in America, we tend to sort of follow their lead. So this professional services consolidation that's been going on, and similarly before that, there was the insurance consolidation. When they exhaust their opportunities, they tend to look over here. So they've come into the whole professional services investment side of things as well.
Okay, well, thank you very much. I think it's something that people need to be aware of. Who else is interested besides people in this country? Well, thank you very much. Right, well, now we're going to move over to Iain, and every session we have of this particular discussion, we invite a guest who will look at some aspect of the market that needs better understanding. And one of the problems we've had is people in private companies say, well, there's illiquidity is an issue, and it stops me from basically going any further. But Iain has a very interesting story to tell. So why don't we go over to you, Iain? Why don't you give the background to yourself and Asset Match and describe a little bit about what you're seeing at the moment, and then we'll continue the discussion. Thank you.
Yeah, thank you very much for inviting me to participate, Richard. I am one of the co-founders of Asset Match. We set the company up 12 years ago. We had spotted at the time that there was a gap in the market to provide liquidity in the shares of private companies, unquoted companies. Even then, there were a number of companies coming into existence through crowdfunding or through angel networks, which had long share registers. And as soon as you have a multitude of shareholders, at some point there will be a desire for some secondary liquidity in the shares. So we set Asset Match up in 2012. We acquired a small business called ShareMark in 2013 from the Share Centre. And ShareMark is relevant for two reasons. One, it brought the first 8 or 10 companies onto the platform. But more importantly, it introduced us to the concept of running auctions in the shares of private companies. As you know, in public markets, there is pretty much continuous trading with various levels of liquidity. But the more we looked at it, the more we became convinced that the way to build liquidity in the shares of an illiquid asset is through an auction. So you're effectively telling the buyers and sellers that they should turn up at the same time. And that way you can create some momentum towards liquidity. So Asset Match runs auctions in the shares of private companies and has done for over a decade. We have about 45 companies whose shares trade on the platform. They include some household names. Tottenham Hotspur Football Club is one, and in fact, we are closing an auction in Tottenham shares today. Brewdog was a high-profile client of ours, so we have a number of companies. Over the lifetime of the platform, we've held over 1,500 auctions. We've traded over £140 million of secondary, and and we have a network of brokers, 40 brokers who send orders into the platform. The auction process involves an algorithm that computes the closing price. It's a fairly simple algorithm, but it fixes on the price at which the most shares would change hands. And the auction process, the algorithm is important, because when you're dealing in private companies, there can be quite a significant disparity in sophistication, knowledge between participants in the auction. And the great thing about our model is that the auction closes at a price, and everybody who is a buyer above that price or a seller below that price ends up trading at that price. It's a very fair system that protects, as I said, the less sophisticated from the very sophisticated. And private markets, as I'm sure you're aware, has had massive focus. I saw a report yesterday from PwC that suggested that global asset under management in private markets would grow to 23 trillion by 2030. So the UK is often considered to be 8 to 10% of one of those global numbers. That suggests that something over £1.5 trillion of assets in private markets will be in the UK by 2030, which is something approaching 2/3 of the total value of the London Stock Exchange. So this is becoming a very, very significant space. And reinforcing that is the recent regulatory announcement from the Treasury and the FCA called PISCES, and I think we're going to go into PISCES, but PISCES is significant in terms of hoping to expand the investor base that looks at this space. One of the factors we've had to cope with over the last 10 or 12 years is that investment in this space is almost exclusively the preserve of high net worth individuals. And for it to expand, two things need to happen. We need to grow the number of companies who think this is an appropriate way to provide liquidity for their shareholders, but also to grow the investor base. So it's a very exciting space. We are right in the midst of it, and I'd be very happy to answer any questions.
Well, thank you very much, Iain. So in terms of the current inquiries that you've been receiving this year, in terms of the volume and the intensity, would you say that more and more people are sort of understanding what you offer and how you can help them?
Yeah, undoubtedly. And PISCES, just a moment's background, stands for Private Intermittent Securities and Capital Exchange Systems. The two important parts of that are private and intermittent. So liquidity cannot be continuous, which of course is the domain of public markets. And this is a major initiative started by the previous government, but picked up with enthusiasm by the current government, and then brought into being by the Treasury and the FCA, as I said. It's a very important initiative because it provides a regulatory framework which will hopefully get companies more comfortable with putting their shares in this space and investors into using it. There is a significant need to grow the investor base, and that will come through providing more background information on the companies, more research being done on the companies, more understanding that there will be ongoing liquidity in their shares. So it's a very important move forward for the secondary liquidity in private markets in general.
So I think a lot of people associate PISCES with the London Stock Exchange, but you're saying that this is a much broader exposure that it offers. And you might just want to say a couple of words about that, because I think there's a lot of misunderstanding about exactly what PISCES is and where it's going.
Yeah, PISCES is a regulatory platform, and there will, I'm sure, over the course of the next few years, be multiple companies that apply to operate a PISCES regulated platform. So the London Stock Exchange was the first company to apply to operate a PISCES platform. And we are 2/3 of the way through the process of applying, which we hope to complete by the end of the year. And anybody who operates a platform will have to construct a rule book and a code of practice that is within the framework. And then we will all be individually out trying to demonstrate to companies that our modus operandi is the best way to create liquidity. And where we're particularly confident of our offering is, we've been doing it for over a decade, but also that the auction-based model is the most satisfactory way to grow liquidity. I mean, it's no accident that when Sotheby's or Christie are selling a major work of art, they do it with an auction. They come up with a time, they tell all the buyers to pitch up, and that's how they build momentum. And we feel strongly the same thing applies in the shares of private companies.
So we've seen a number of companies delisting from AIM and Aquis this year. Are these the sort of companies that are attracted to your style of platform, or are you finding that the growth in your business is from private companies that want to reach a bigger investor base, but for various reasons aren't actually able or do not want to go public?
Yeah, that's a very good question. We find companies come from three different distinct areas. I mean, the first one is you say, are companies that are leaving the stock exchange or AIM, and who've tried the experience of being public and for one reason or another hasn't worked out. Then there is a raft of companies, maybe predominantly majority family owned, but which have long share registers, who actually have never been public, have probably never really wanted to go public, and may not want to go public in the future, but who have a share register that needs liquidity. And then the third group, and probably the most exciting group, are those that aspire to some point in the future to go public, but have concluded that now is probably not the right time. And it's it sort of relates to the first part of your question. IPOing at the wrong time can be fatal or close to fatal. And we feel strongly that what we do is allow people to pick the time that suits them, not necessarily pick the time that suits some of their shareholders who want liquidity.
Thank you very much, Iain. So I'm just going to take the opportunity now to say that a week or so ago, Hardman Co held a panel at the Mello conference in London on EIS and also on liquidity in markets. And Iain, thank you very much for turning up for the second panel. And if anybody wants to hear more about Iain or the background to this discussion, I suggest you can either look on the Mello website or you can contact us and we can send you the details. So I think, looking at the clock, I think we might be running out of time. So Matt and Iain, thank you very much indeed. So I need to draw this discussion to a close. Thank you to our audience for listening. Now, these sessions have become very popular, so we have decided to hold the next private company valuation Hardman Talks at the end of January, and we will be sending out details in due course. In the meantime, I'd like to wish everybody a very happy Christmas and New Year. And if you have any questions or you would like to contact either Iain or Matt, please do so. But thank you very much indeed, and goodbye.